Have you ever wondered how Michael Saylor is able to turn Bitcoin's wild volatility into something stable, predictable, and insanely profitable? Because in this segment of his 58-minute Cantor Crypto Keynote, Saylor reveals the financial engineering blueprint behind Strategy's entire Bitcoin strategy. And in today's video, part 3 of this series, we're breaking down one of the most misunderstood, most brilliant sections of his talk. How Strategy strips volatility, creates digital credit, and turns Bitcoin into the foundation of a new financial system. If you haven't watched parts 1 and 2, don't worry. Each episode is designed to stand alone. The goal of this series is to make Saylor's keynote easy to digest, easy to understand, and accessible to everyday investors. All right, let's jump into the 6-minute segment directly from Saylor himself, and then I'll come back to break it all down in plain English.
Our company's raised a lot of money. We raised a ton of money via equity issuance, a lot of money by bonds, and in the last 12 months, we've really rotated to raising capital via preferred stocks and preferred credit instruments, and that has taken off. Now, what is the Treasury business model? We're really financial engineers, right? We engage in financial structuring or structuring of we're a structured finance company, if you will. And what you can see here is the raw asset is Bitcoin. It's got a 51% ARR and a 43 vol over the past 30 days. If what you wanted was that, you could just buy it. But what we've done is we strip the volatility and the risk off of the asset. So we strip a bunch off with Strike down to 29, then 18, then 15. And Stretch, we stripped it down to 8% in the last 12 weeks. Stretch today, it's targeted at 100. It traded between 96 cents and 107 cents, but it's down to trading plus or minus 4 cents or 5 cents. If that trend continues, the vol on Stretch will go to 1 or 2. And so what we're really doing is stripping the volatility off of the pure economic asset. There's conservation of energy in the universe. Where does the volatility go? It goes to the equity. If I actually convert 50% a year performance into 11% performance, where's the extra performance go? Goes to the equity. So what we're doing is fairly elementary. We're just stripping the performance and stripping the volatility and stripping the risk, and the extra risk, the extra performance, the extra volatility goes to the equity. And that's why a business that has $70 billion in digital capital can create $3 billion of very, very low volatility credit. It's not that different, again, to take a barrel of crude oil and you take crude oil, if you distill it to the highest, most distilled form, you have kerosene. Kerosene is jet fuel. Kerosene is rocket fuel. Now I'm going to make a joke. If you study the history of science, it's full of examples of people that saw breakthrough technology, but they used the technology the wrong way because they were conventional thinkers. The idiom is repaving cow paths. It's like you invent concrete and you could create a 6-lane superhighway and the car could go 90 miles an hour, but instead I take the concrete and then I put it over a cow path that was meant for a cow that moves 4 miles an hour. And now I've got a paved cow path where cows can now move 4.5 miles an hour. You got no benefit from the technology because you used it the wrong way. Now I'm going to give you an example here. John D. Rockefeller, distills kerosene, and you're in the horse and buggy business. So what do? Well, you create a kerosene lamp, and you put a kerosene lamp in the back of the horse and buggy so that your customers can travel across the country by horse and buggy with a kerosene lamp and read a book. Or you put a kerosene heater in the back of the horse and buggy, and you brag that now you've got a warmed horse and buggy, and you won't be cold while you're in the horse and buggy. But a dude like Ford comes along and thinks, well, maybe we'll just create an automobile and we'll drive with gasoline. Or maybe Boeing comes along and creates an airplane and we just fly across the country. So there's a compelling thing to do with the kerosene, like rockets and jets. And there's gasoline and there's cars. But there's also the trivial application of the technology, which just makes the horse and buggy 1% better. And yet you'll have the greatest business people of the era made all their money with horse and buggies, and they're going to grab the kerosene, put a kerosene lamp in the back of the buggy, and they're going to declare that they've used the technology for the good of their shareholders. And what I would say here is you just have to think different, and you have to think much bigger with regard to what you can accomplish here with this technique. What we do is we accrete Bitcoin per share, right? So our equity investors want more Bitcoin per share. We started with 56,000 Satoshis a share, and we added every single year. We added about 74% more last year and 26% more this year. There's a lot of ways to do it. You can sell equity, you can sell bonds, you can sell preferred stocks, you can sweep cash flows. This is a snapshot of the company's balance sheet. In essence, we're 1.1 levered, we're 1.3 times amplified, and we have 84 years of dividends. You know, when Lehman got in trouble, they were 30x levered, and then they went to 50x levered. At one point, they had $15 billion of equity and $750 billion of assets, right? So I get preached to a lot by finance bros that want to tell me don't get too levered. But what I want to point out is we're not even 2x levered. And literally the leverage is going to 1. That debt is going to go away. So the interesting thing to do here, of course, is to use credit that is equity to amplify your performance, because if you do that, you can do it without credit risk. And it's very interesting. Our future is in credit issuance, right? What I said, the day you were born and the day you figure out why. Why are we here? We're here to sell digital credit. And the product is the credit. And so we just got a credit rating from the S&P. We're the first digital treasury company to get a credit rating. It's pretty much the worst credit rating you could justify. We're starting at the bottom and we're crawling up. And it's predicated upon the Basel Accord, which it suggests that Bitcoin is worth zero. It's zero capital. So you have a banking establishment that values Bitcoin as zero, but you have the marketplace that thinks it's worth $70 billion. Over time, we will rectify that, just like with accounting standards, we were able to rectify that. And as that gets improved, then our credit ratings will move up. But the significance of a B credit rating is that instead of having access to 2.8 trillion worth of capital, you now have access to another 4.9 trillion. So we 3x the addressable market for credit instruments that we're selling. And the most important thing is to allow fixed income investors and insurance companies to allocate to that part of their portfolio. So we thought that was auspicious. Our ambition is just to continue to improve the credit rating until we're an investment grade issuer of credit. And that takes me to the product, right? The product is digital credit, right? Did it exist a year ago? No. We invented it. Necessity is the mother of invention. Why do we invent digital credit? Because traditional bonds are too risky. We tried traditional bonds. We tried asset-backed borrowing. We found that either the bond market wasn't large enough or wasn't stable enough. And pairing traditional short-duration credit instruments like bonds with an asset like Bitcoin, which is highly volatile, creates a very dangerous situation where you might get forced liquidated, or you might get yourself into a credit crisis. That's not good for the equity. And so over time, right, this is the conundrum that every financier has, right? How do you go bankrupt? You lend long, you borrow short, right? A bank has overnight deposits and puts out 30-year money, and then people want their deposits back, and you can't call the loans, and so you get a run on the bank. When Lehman went out of business, they were borrowing $700 billion for 15 days, and then they were invested in mortgage-backed securities and real estate with a 5, 10, 20-year duration. So obviously, you don't want to mismatch your durations. If your goal is to buy an asset, what is Bitcoin? Bitcoin is a 10-year duration asset. If you're going to buy it, a normal time frame would be 10 years, 120 months. So what you want is a duration on your liabilities that is comparable to that duration of Bitcoin. So how do you get to 10-year duration money? You can't do it with 5-year loans. So we started thinking that what we'd like is to get 10 to 20-year duration, and the way to get that is with preferred equity. And so we went to the market and we thought we're going to sell preferred equity, and we found that the market wants a higher dividend yield for preferred equity than for bonds. And our first reaction was, oh, that's bad, that's a bug. And then after a while, we realized that's actually a feature. If we're paying 200 basis points more than we thought we should pay, then our credit just became the highest yielding credit in the world. And when you flip it from a bug to a feature, then you start to see something different, which is the credit that we issued from 2020 to 2024 was tactical credit in order to amplify the equity. We were trying to, the product was the equity, and the credit was the tactic. And what happened in the last 12 months is an inversion of the business model, where we realized that the credit is the product and the equity is the afterthought. The equity follows from the credit, and the real product is, what if I gave 10% dividend yield to 1 billion people tax deferred and stripped the risk off it? Well, that's a product that would appeal to everybody, but maybe more interesting, that might be the best product in the world. Say that again, that might be the best product in the world. If you can give someone 600 to 800% of additional yield over the risk-free rate in a non-volatile instrument in the currency of their choice, you've created maybe the perfect product, because that's what everybody wants. And we tripped over that.
Saylor starts by treating Bitcoin like a raw economic asset. Left alone, it's volatile. It has huge ups, big downs, and massive performance. But strategy doesn't just hold it. They refine it the way Rockefeller refined crude oil into kerosene, jet fuel, and rocket fuel. They strip out volatility, risk, and excess performance. And then they redirect all that volatility and excess upside to their equity holders, the owners of strategy stock. This is why MSTR outperforms Bitcoin by multiples. This isn't luck, it's engineering. Where does the volatility go? This is one of the most important ideas in the entire keynote. Saylor says volatility is conserved. If strategy takes Bitcoin's 50% annual performance and squeezes it down to an 11% yield in a stable credit product, the other 39% doesn't disappear. It flows to the equity, to the shareholders. That's why strategy continues to accrete more and more Bitcoin per share every single year. More Bitcoin per share equals more upside for the shareholders. Don't repave the cow paths, you gotta think bigger. This part is classic Saylor. He warns against taking new technology and using it in small, incremental ways, like putting kerosene lamps on a horse and buggy carriages. Instead, he believes Bitcoin enables entirely new financial structures, just like kerosene enabled cars, jets, and rockets. Strategy isn't just using Bitcoin to improve the old world by 1%. They're building the new financial world from scratch. Accreting Bitcoin per share, this is their number one metric. Saylor reveals how much strategy grows its Bitcoin per share, issuing equity, bonds, preferred stocks, and sweeping cash flows. Every tool is used to acquire more Bitcoin, not dollars. Because to Saylor, Bitcoin is the superior treasury asset. They currently run a 1.1x leverage, far safer than legacy financial companies like Lehman, which ran up to 50x leverage. This is Bitcoin-backed credit, not fiat-backed speculation. The future, issuing digital credit. This is the most groundbreaking section of the whole talk. Saylor says the purpose of strategy is now clear. They exist to sell digital credit. This is Apple inventing the iPhone. It's Amazon inventing AWS. This is Tesla inventing the modern battery supply chain. Strategy is inventing a new category of financial asset, a low volatility, Bitcoin-backed credit instrument, offering yields far higher than traditional fixed income without the volatility of Bitcoin itself. This is financial rocket fuel, and institutions want it. As Saylor explains, banks still treat Bitcoin as worth zero, but the market values Strategy's Bitcoin at $70 billion. As credit ratings improve, trillions in fixed income capital become available. This is the beginning of Bitcoin penetrating the global bond market. Why digital credit might become the best product in the world? Saylor ends with this bold claim. If you can offer people a 10% yield, tax deferred, denominated in their currency with no Bitcoin volatility, you may have the best financial product ever invented. This is the inversion of Strategy's entire business model. Before, equity was the product, credit was the tool. Now, credit is a product, equity is the byproduct. This is the birth of digital credit, and it could reshape global finance. So that's the power of this section of Saylor's keynote. He's not only just buying Bitcoin, he's building a new financial engine that refines Bitcoin into a stable yield products, opens trillions in credit markets, and accelerates the world's transition to a Bitcoin-based monetary system. In the next episode of the series, we're going to break down how Strategy plans to scale this digital credit model globally and why Saylor believes this is the future of corporate finance. If you're finding these breakdowns helpful, hit like, subscribe, and drop a comment with what part of Saylor's keynote you want to decode next. See you in part 4.